The tech industry is on the cusp of a major revolution, and Alphabet is leading the charge with its pioneering work in AI, cloud computing, and search. Alphabet is poised to disturb the status quo and makes its investors rich. In this video, I will explore the latest developments at Alphabet and reveal the secret to making a fortune in the stock market. Hey there, Tamir from Fibonacci-Traders.com here. Welcome for another episode, Stock a Day. Like, subscribe, and let's talk Google. Alphabet is scheduled to report its third quarter of 2024 financial results on October of 29th, and investors are wondering if they should buy the stock before or after the earnings release. In its latest quarterly release, Alphabet's CEO said that their strong performance highlights their ongoing strength in research and momentum in cloud computing. They're also making significant strides in artificial intelligence, which is an area where they got off to a late start. The company's CFO added that they're committed to creating investment capacity by re-engineering their cost base. This is important because it allows them to free up capital to invest in AI and other growth areas. Alphabet has made several cost-cutting moves, including cutting over 10,000 jobs in late of 2022 and early of 2023. Despite these efforts, the company's revenue increased by 14% year over year in the quarter that ended on June 30, 2024. This is double the rate of growth they experienced in the same quarter in 2023. Their operating profitability also jumped from 29 to 32%, which is impressive considering their significant investments in AI and other areas. Other area where Alphabet is leading is the way it's in driverless car technology. Their Waymo unit is already offering driverless rides in several cities, including LA and San Francisco. This is a significant advantage over competitors like Tesla, which is still trying to make promises about driverless cars in 2027. Alphabet's job-cutting efforts have also been successful, with the company reducing its employee count from 181,000 to 179,000. The company's investments in hardware and tech have primarily been focused on AI-optimized data centers. They've also been updating and upgrading their data centers from a decade ago, which is allowing them to get a better total of cost of ownership. Alphabet has also a lot of cash on its balance sheet, and investors have been complaining that the company is just hoarding it. However, Alphabet is now investing in artificial intelligence, and I think that's a good use of their capital. As an investor, I'm happy to see Alphabet finding opportunities to allocate its capital. The company has proven to be responsibly good at allocating capital, and they have been conservative in their capital expenditures. Alphabet's business model is very lucrative, and they generate a lot of cash flow from operations. This allows them to invest in moonshots, which can be risky, but also potentially very rewarding. One example of a successful moonshot is Waymo, which is already generating revenue and is a leader in the driverless car market. Alphabet's investment in AI-optimized data centers are also good use of their capital. The company has a lot of cash on its balance sheet, and they're using it to invest in areas that will drive growth and innovation. From December 31st of 2023 to June 30th of 2024, they've added roughly $17 million in property and equipment. For Alphabet, the vast majority of its property and equipment is data centers. They have plenty of money to use to do that, with $110 billion in cash and marketable securities as of December 31st of 2023. That's down to 100 billion. So they used 10 billion of that. And of course, the business itself generates so much cash flow from operations that they can allocate some of that to these investments in AI, which as an investor, you like to see that from a company that's proven successful doing it. If it's a company that's not good at allocating capital, right? If I was to look at, let's say, AMC theaters, they've been proven so unsuccessful at allocating capital. They've proven so unsuccessful in innovating to business. You haven't seen anything innovative from that company, and their capital has been spent inefficiently. You don't want to see them spend more money on the business. You just want to see them get the business to generate cash flow and then give that cash flow back to investors. Try to shrink the business because people are not going to movies as much as they were going 10 years ago. And that's never going to change. Going to the movies has become so expensive compared to other entertainment options that it's not something that people are going to do again. So, with that kind of business, you don't want to see them spend money. But with a business like Alphabet, a lucrative business model, proven successful allocating capital, you want to see them find things to do with that money. And it's good news to see them investing in these AI optimized data centers. So, should you buy the stock before earnings release? Well, it's trading at a forward price to earnings ratio of 19, which is still very cheap for this company with this kind of prospect and this kind of business model with this kind of market share and competitive advantage. As I see it as equally weighted on both sides of this equation. Now, you have the risk of missing out if you don't buy ahead of earnings. You also have the risk of buying ahead of earnings and then the stock will fall by 17%, as we saw with ASML just a few days ago. That was a prime example of why it pays to buy a little bit before and a little bit after. I'm talking as an investor's point of view, because if there's a big drop like ASML, you allocate half of your investment at that lower valuation. And half, of course, you already invested, so you lose out on the 17% of your initial investment. But at least on the second half of your investment, you get to have that 17% lower valuation. And now, ladies and gentlemen, let's take a look at Google's chart. So here we have Google chart on the daily, Google chart on the weekly. Always zoom in, zoom out to get a better point of view of price action. And if we look at on the weekly chart, we can clearly see that the 1764 area, very tough resistance area since beginning of August. That's 2.5 months of a very tough resistance, except this example, this candle over here, the end of September. But beside it, we have 2.5 months of a very tough resistance, 170, 157, 147, and you also have the gap at the 143, and we know that more than 85% of all gaps will get filled throughout time. It's not a matter of if, it's always a matter of when. And also we have here this long-term uptrend line that holds the higher lows since April of 2023. That's 1.5 years, 18 months of holding above this red line. Let's see, can we get going and retesting this area over here, the 157, together with this trend line, and then bounce back up? This is how it looks on the daily. Nothing much also on the daily. As we can see on the daily since September 19th, already 1 month, we are stuck at the same price range, 159.70 to the downside, 169 to the upside. Very similar price action that we saw over here. Now, breaking above the 169, can we get the same price action we saw over here to the downside? Can we get the same price action to the upside? What do you think? After earnings, can we get this price action going towards 190, maybe 194 post earnings? Once again, thank you very much for watching this video. I do hope you found it helpful and educational. If so, like, subscribe, check the links in the description below for more educational resources. Until the next video, stay safe.